Welcome back to Investing Talk podcast. Today we are jumping into an analysis of Applovin. I mean, this is a company that's really turned heads with its financial performance over the last year. And the big question, the one we're tackling, is pretty fundamental. Is now a good time to actually buy the stock? We've got, well, a whole stack of recent financials, analyst reports, market data, basically everything up to October 17th, 2025 to try and give you the full picture.
Yeah, and it's tough, right? Especially in ad tech, you see these huge growth numbers, but then these really high valuations alongside them. So our goal today is, cut through that noise a bit, synthesize what matters, and give you some clear insights into, well, the investment case for Applovin.
Excellent. Now, before we really dive in, just a quick reminder for everyone listening. If you find this kind of analysis helpful, please do hit subscribe, like the video, maybe leave us a comment. We genuinely love hearing from you. And hey, if there's a specific company you want us to look into next time, definitely drop us a name in the comments below. Okay, let's get started where you have to start, the financials. What Applovin did in 2024 was, frankly, pretty stunning. It really cements their place as a high-growth player.
Oh, absolutely. You need these headline numbers for context, especially for the valuation talk later. So full year 2024, Applovin pulled in $4.71 billion in revenue. Compare that to $3.28 billion in 2023. That's a 43.4% jump year over year. Huge acceleration. Shows their tech is really capturing those mobile ad dollars.
And that revenue jump is impressive, definitely. But it almost seems small compared to how their profits exploded. It looks like they've cracked the code on scaling efficiently.
That's exactly it. The profitability surge is the real story here. Net income hit $1.58 billion in 2024. And that wasn't just, a decent increase. We're talking 344.3% growth over the previous year's net income. That points to some serious operational efficiency. They're turning scale into real profit.
Okay, let's tackle the elephant in the room then, the valuation. October 2025 trailing 12 months EPS is $7.03. But that TTM price to earnings ratio, it's sitting way up there at 84.86. For a lot of investors, that's like an immediate nope. How do we square that?
Well, it's all about expectations, isn't it? And the kind of growth we're seeing. 84 is high, no doubt. But the market's basically saying we expect this crazy growth to continue. And crucially, look at the forward PE based on projections. That drops significantly, down to about 50.95. So that high TTM number isn't a mistake. It's investors betting that the 300% plus earnings growth can continue, and they're willing to pay a premium today for those future profits.
So the bet is Applovin's past the heavy spending phase, and now it's more about harvesting profits from this efficient system they've built.
Pretty much. And they've got the balance sheet to back it up. It's really robust, actually. Big cash cushion, strong free cash flow generation consistently. That financial stability is key. It gives them options, right? Funding R&D, maybe looking at M&A to speed things up, or just riding out market bumps.
Makes sense. That cash isn't just sitting there. It's fuel for defending their position and making this next big move. Which brings us nicely to, well, how are they defending their turf? And where are they aiming next? What's the competitive advantage?
The advantage, the moat, it's technical. It's deep in the mobile app world. Their dominance comes from this whole ad tech stack they've built for monetization and advertising.
Can you break that down a bit? Like, what's the specific tech that makes them so dominant? Not just superior technology,
Okay, yeah. It boils down to two key proprietary things: App Discovery and Max. App Discovery handles the real-time ad auctions, but Max is the real disruptor. See, developers used to use this clunky waterfall system for ads. Slow, inefficient, left money on the table. Max is their in-app bidding tech. It just throws out that old waterfall. Everyone bids at the same time, in real time. For a developer, that means, boom, instantly more money for every single ad impression because it's sold at the maximum current value. That kind of immediate ROI makes clients very sticky. That's why Max is considered best in class.
Right, okay. That's a very tangible advantage, literally making your customers more money right away.
And there's more. They also own Adjust. That's their measurement and analytics suite. Tracks everything: campaign results, user retention, ROI. So they own the ad delivery platform, Max and App Discovery, and the measurement tool, Adjust. Creates this closed loop. The data they get from that is incredibly valuable, boosts retention, and honestly, makes it really hard for anyone else to just jump in and compete.
Got it. So a strong technological moat. Now let's talk about this pivot everyone's excited about. Applovin grew up on mobile gaming, but the focus seems broader now.
Absolutely. This is the big strategic shift. And yeah, it's what's been driving a lot of the recent market excitement. They're making a really aggressive push beyond gaming into the huge market of non-gaming direct-to-consumer e-commerce. Think about major categories spending big on mobile ads, apparel, beauty and fitness, health and wellness, stuff like that. The idea is their AI ad engine, which they've honed for years on gaining data, can be retuned pretty easily to find high-intent shoppers for e-commerce brands.
And investors reacted immediately to that, didn't they? Early October, the stock jumped, what, over 6%? Just on optimism about this e-commerce move and the upcoming AXON Ads Manager launch.
Exactly. AXON is designed specifically for these non-gaming verticals. That's the new growth story everyone's watching.
Okay, let's shift gears slightly. We've covered fundamentals, strategy. What about the market itself? What are the charts telling us about how investors feel?
Well, the charts are definitely mirroring the enthusiasm we've seen in the financials the last 3 months. Very strong bullish trend. You're seeing consistent higher highs, higher lows. That's textbook accumulation, likely by bigger institutional players.
So the momentum looks solid.
Structurally, yes. The price is well above key moving averages. The 50-day is around $552.56, and the 200-day, that's way down at $392.03. Staying so far above that 200-day line, that suggests real underlying strength. The long-term upward trend seems pretty firmly in place.
And Wall Street seems to agree. Analyst sentiment has been consistently positive, right? We saw some big price target hikes recently.
We certainly did. Both securities pushed their target up to $860. Citigroup went to $850. And importantly, both specifically called out that expected growth in e-commerce ad spending. They directly linked their higher targets to that strategic pivot we were just talking about. So yeah, the consensus right now is basically a solid buy.
Okay, but let's inject a dose of reality here. With such strong upward moves, isn't there a danger the stock's gotten, ahead of itself, overheated?
It's a fair question, always worth checking. But interestingly, the Relative Strength Index, the RSI, it's actually pretty neutral right now, around 45.3, which is potentially good news for buyers. It suggests the stock isn't technically overbought yet. There's still room, potentially, for more gains before you hit those levels that usually trigger a correction.
Yeah.
However, and this is a big however, you absolutely cannot ignore the volatility here. The stock's beta is 2.53. That means its price swings tend to be 2.5 times bigger than the overall market swings.
Whoa.
Yeah. So when the market's up, Applovin can fly. But when the market turns down, expect this one to fall harder and faster. It amplifies everything.
Okay, so with that kind of high-octane volatility,
Okay.
how sure are we that this pivot into non-gaming is solid enough? If that growth story stumbles even a little, that beta could really hurt.
That's the central tension, isn't it?
Yeah.
The confidence comes back to the tech, the moat we talked about. The market's betting that Max and Adjust are so good, they'll pull in those big e-commerce advertisers quickly because the ROI is just so compelling, even if the broader economy is shaky. But you're right, execution on the AXON rollout is absolutely critical to keeping that confidence high.
Speaking of execution, what's the next big thing we need to keep an eye on? The most critical near-term event?
That's got to be the Q3 2025 earnings report. It's scheduled for November 5th. That's the immediate catalyst. It'll either pour fuel on this bullish fire or throw some water on it. Expectations are definitely running high after the recent stock performance.
And what specifically will analysts be digging into in that report beyond just revenue and earnings per share?
3 main things, I'd say. First, are they still showing that operational leverage? Can margins stay high as they grow? Second, just continued proof of growth acceleration, quarter on quarter. But probably the most critical piece will be updates on AXON Ads Manager, real traction updates. How's it actually doing in penetrating those non-gaming e-commerce verticals? That's what everyone wants to know. Success there is key right now.
Right. And beyond earnings, are there other potential catalysts bubbling under the surface?
Well, there's always market chatter. Given their cash pile, M&A comes up a lot. Maybe they buy a smaller, specialized e-commerce ad firm to accelerate that non-gaming push. It's plausible.
Any tech advancements on the horizon?
There are whispers.
Yeah.
Industry insiders hinting about new AI-powered ad targeting features maybe coming in early 2026 that could further separate them from, say, Meta or Google in the mobile ad fight.
Okay, exciting stuff. But we have to balance it. What are the key risks we need to keep front and center?
Number one is that volatility. That beta of 2.53 we keep mentioning. If the broader market takes a nosedive, this stock will likely get hit hard. That's a portfolio construction risk you have to acknowledge. Operationally, there's still some customer concentration risk, which is common in ad tech. And fundamentally, they rely heavily on Apple's iOS and Google's Android. Any major policy change from Apple or Google, especially around privacy or data tracking, could seriously impact how well Applovin can target ads. That's an ongoing dependency.
And the inevitable regulatory cloud that seems to follow successful tech platforms.
Exactly. As Applovin gets bigger, especially moving into these broader consumer categories, they're going to attract more regulatory attention. Data privacy, market power, those questions will likely intensify. Evolving regulations are just a constant factor they'll need to navigate.
So look, if we synthesize all this for you, Applovin looks like a really strong, bullish story right now. The numbers back it up, the technicals back it up, but the whole investment case really hangs on them successfully executing this shift into non-gaming e-commerce and getting widespread adoption there, which kind of makes it interesting for potentially two types of investors, doesn't it? You've got maybe shorter-term traders looking at that Q3 earnings report as a catalyst, potentially eyeing a move into the, say, $580 or $650 range if things go well. But then you also have long-term investors who see the structural growth, the industry leadership, and think, okay, this could be a compounder over several years.
Precisely. And that leads to the final question, really, for you to think about for your own portfolio. You've got this high valuation, these huge growth expectations baked in. How do you personally weigh that proven competitive advantage, the max and adjust tech, against that undeniable significant risk from the high volatility, that 2.53 beta? Where does that fit in your risk tolerance?
A very important question indeed. Food for thought. All right, that wraps up our look at Applovin for today. Thanks so much for tuning in to Investing Talk Podcast. We'll catch you on the next one.